Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 56. So on today's episode, we're going to talk about earnings. We had some big earnings this past week. We have a lot of earnings coming up this week. And so I just want to talk to you about what do I look for when I'm looking at these earnings reports? How does that go into my thinking on these companies? And then we're probably going to have a Fed rate hike this week. So there's a lot of just kind of current financial data that we need to discuss this week, along with maybe some other financial quips to help you along your journey. So get your mind right. Let's get to work. Okay, well, welcome back to the show, everybody. I want to apologize in advance. I've been fighting a cold all week, so if my voice sounds weird, that is why. Can't hear. It's just having a cold in the middle of the summer when it's, 105 outside, just seems like there's something wrong with that. So that, and I'm 2 months out from the Berlin Marathon this week. So I'm like, man, just trying to get ready, pumping the vitamin C, trying to get some long runs in, doing a lot of treadmill training this time because it's just so hot outside. So we'll see. This could be the struggle bus in 2 months, but we'll fight through it. So another exciting thing, I'm going to talk about this at the beginning and the end. So there's a new tool out there that we're going to start using called Speakpipe. So this is a way for you to record a short, short as you want, minute and a half voicemail to me asking whatever financial questions, stock questions, finance questions, financial planning questions, whatever you want. It can be completely anonymous. So if you go to www.speakpipe.com/investor professor, you'll see our logo. You can record a message. It'll email it to me, and then I can use it on a future show. I can also download it and actually input your audio into the show, which will be pretty neat. So it'll be a way for you to actually ask some questions, and I think that'll be fun. It'll also there'll be a link in the show notes. So if you go wherever you're downloading this podcast from, you'll be able to click the link there. It'll take you right to it, and you can do it straight from your phone. So let's have some fun with that, see how it goes. All right, so this past week we had a lot of earnings from banks. We had Tesla. We had a lot of companies kicking off the earnings. Some of them were good, some of them were bad. And so the reason I like earnings season is because I've said it before, but in between when companies report, it's just so much noise, right? We've had episodes where we just talk about the amount of financial noise that's out there. And so the nice thing about earnings is you actually get to hear from the companies themselves. They get to tell you from their own mouths how they think they're doing, how they think the economy's doing. And of course, this becomes kind of who separates the good companies from the bad. And, there's not that many good companies out there. I mean, there really isn't. And, when you start doing your investment analysis and you're looking at companies, it really starts to, you start seeing that there's just not that many good companies out there. And so many investors waste their time with companies that are just kind of average or below average. So looking at these earnings, and by the way, the market did well this past week. We finally I think we've had 2 weeks of gains. We're 5% up from the lows we hit for the year. I mean, it's still not a great year. The NASDAQ is still down 24%. The S&P is down around 17%. But a couple of weeks ago, this was looking a lot worse. So at least the pain train has slowed for a little bit. But when you look at some of these earnings, you look at a lot of the major banks reported, and it's interesting to see what they said. And so I encourage you can go to any investor relations website, and you can listen to the conference calls of the companies that have reported. And that is really where, I mean, it's one thing to look at the numbers, but when you get the, kind of the stories behind those numbers and what they're seeing, that becomes very important as well. So one of the companies that I've been buying for myself, I've been buying for clients, is Goldman Sachs. So Goldman Sachs this year has gone from, 407 on January 4th, and it got as low as 281. And this is one that under 300, I've really been pretty aggressive. PE ratio, which is price to earnings, was at 5. Pay a good dividend of 2.45, 2.5%, depending on where you get it. And so Goldman Sachs Investment Bank, one of their main sources of income are IPOs, right? Initial public offerings. Well, during bad years, you know that they're not going to get a lot of initial public offerings. And so that's one of the reasons that the stock is sold off. And I'm okay with that. Like I look at that and go, okay, IPO market is not going to be great every single year, but they also have a big bond or big trading floor. And that's not necessarily where they want the driver of their business to be. But you go, they do their report this week and they had good earnings. They had great earnings, obviously not in the IPO section, but they did on the bond side of things. The trading desk did well. And so you see the stock this past week alone went from $299 up to $323 again. And so I still look at that and I go, man, their PE ratio is still 7. Obviously, there's still some work to be done. But on weakness, I look at this stock and go, man, this is a stock I want to own for the next 3 to 5 years. And I think I can do very well with it. And so it's just finding deals like that. Bank of America, Goldman's a little expensive at $3.23 a share. Bank of America is only 33 cents a share, right? PE ratio of 10, dividend of 2.6%. I mean, these are companies that are going to be willing to, they're paying you to wait. At the beginning of the year, Bank of America was $49. Now it's $33. So you're getting a huge discount on that. But, you look at these companies and, they tell you that, okay, the economy's bad, but maybe it's not as bad as the news is telling us. American Express is another one. They reported for yesterday and they went up huge right when they reported, went from 150 to 160, and basically said they're not seeing any weakness in their consumers. Now, American Express is known for having higher end consumers. One of the things I like about them is in their last year's annual report, they talked about how many of their new cardholders were Generation Z, younger cardholders, which is very important for the future of their business. And, American Express has been very good about keeping customers, that they're very loyal to them. So getting younger customers, I think more than 50% of all the card holders that they added were younger. So it's a nice company, that if you can get it at a discount, looks good for the future. And so, but then you look at some of them. AT&T, for example, got crushed this week. Went from, $20.49 down to $18.45. AT&T has struggled. They spun off Warner Brothers Discovery earlier this year, and so they're kind of revamping the company. But one of the things they said they saw is that some of their lower end consumers are starting to take a longer period of time to pay their bills. Right? So, cracks in the armor, so to speak, for the economy. And so depending on the company that you're looking at, a weaker economy can impact them in a different way. Not every segment of the economy slows down at the same pace. And so, but AT&T, I think, I look at this, $18.40, paying a dividend of 5.87. I've said it over and over again. Most people pay their cell phone bill before they'll eat. And, AT&T has said they have tons of data. These people that, maybe are late on paying their bills do eventually pay their bills. So I think that one might have sold off a little too much. One of the ones that I think is interesting, and so you saw the market sell off on Friday because of Snapchat. So Snapchat was down 40%. Jeez, 40% on Friday. Boy, that is rough. So year to date, Snapchat has gone from $46 down to $9.96. And this week was rough for them, showing that, I mean, gosh, just on Friday alone, they went from 16 down to $9.89. So a 40% drop. And they're one of the main reasons that the NASDAQ fell so hard on Friday. And I find it interesting. So obviously Snapchat, they're saying advertisers are slowing down. People aren't advertising as much. So because Snapchat's earnings are bad, everybody immediately goes and sells Meta, Facebook, Meta, and Google, Alphabet. And so I sit there and go, well, man, Alphabet is not the same. Google is not the same as Snapchat, right? Most of the money, most of the advertising money that is spent is on Meta and Google. It's throwing me off. Facebook changing to Meta and Alphabet changing, or Google changing to Alphabet. I always struggle on what to call these companies. But the advertisers, I mean, we'll see this week. So this next week, we have Meta reports, Alphabet reports, and we'll see how this happens. But the last 3 quarters in a row, I've noticed that Snapchat reports bad earnings, and then all of a sudden, Google's earnings will be great, and then it completely reverses, and Google spikes after the earnings. So we'll see. But you're right. I mean, if we have an economic slowdown, there isn't going to be as many advertising dollars to go around. But I don't think that impacts Google as much as it does Snapchat, Pinterest. I think that advertisers take their advertising dollars away from more of those peripheral applications than they do something like Google. So we'll see. The other one that reported this past week was Tesla. And Tesla had a good report, even though their Shanghai factory was closed for most of the quarter. Before Tesla reported earnings, they were $7.42. They closed at $8.16 for the week. And if you want to say any detractions from their quarter, is that their margin is shrinking a little bit. So margin, when you hear the financial press talk about a company's margins, it's basically how much do they make off of the product they serve or that they sell. So if they make it for $100, they sell it for $130, that means they're making 30% margins. And so having high margins allows a company more flexibility. So when the economy gets tough, or the cost of things change, think about inflation, there's some flexibility in that margin, right, percentage, that they can lower costs, change input costs. They have some flexibility. So technology companies are known for having higher margins. Pharmaceuticals have high margins so they can keep research and development. Companies that have low margins would be airlines, restaurants. Those are very thin margins. And so they're trying to make it up on volume. So depending on what a company's strategy is, the margins matter a little bit more than others. Walmart, for example, low margins. Amazon's retail business, low margins. Their Amazon Web Services has high margins. It just kind of depends on what the business is. But it is important to factor that in, because it does impact the profitability of a company. So companies, historically, the stocks that are doing the best are going to be the ones that have really high margins. And especially in the beginning, if they have a new product, they'll have high margins, and then competitors come in, they try to lower those margins. But that's kind of the business cycle. But Tesla, so the piece on this, on their quarter, would be that their margins were a little bit lower than they have been in the past. But I think that has more to do with the Shanghai shutdown, cost of getting the supplies that they need. But it's very interesting. And in the beginning, I said you can go listen to a conference call, and you should. You can go look up Tesla's conference call. You can hear Elon Musk talking about the quarter, talking about some of their challenges, talking about the things that are getting better. And it really is a nice way, especially if you're invested in a company, to go hear how they're doing from the management team that is actually managing the company, and not just people who are trying to do a 5-minute clip, on CNBC. So this week ahead, we're going to have a lot of major earnings this week. Like I said, you'll have Google, you'll have, I believe, Amazon reports this week. You're going to have Apple. Apple's going to be really key to the market overall this week. Apple is kind of the bellwether of all bellwethers. So if they can do a good quarter with some of the challenges that they've had, that is also going to kind of send the market in one direction or another. We'll have the Fed meeting this week. There should be another interest rate increase this week. The market is expecting 75 basis points again. You shouldn't see the market move too much based on that. I mean, it's pretty much factored in at this point. It'll be more the commentary because the next Fed meeting isn't going to be until September. So there'll be a month in between. But some of the economic data coming out is showing that, you've seen a lot of reports of companies that are either looking to let people go, they're looking to freeze hiring, starting to see signs that the economy could be slowing, and that should be a way to bring inflation down. Oil prices have come down. Gas prices have started to come down. So that demand is going to, if that demand keeps falling, we should start seeing some better inflation data, which will be better for the stock market for sure. If you get any kind of good news, right? There's so much bad news out there. If we get any kind of good news, it should help the market recover a little bit more. So we'll see. This could be a week of definitely some landmines and something to pay attention to when you're looking at kind of your portfolio. But if you're looking out over the next couple of years, I mean, it would be nice to have a little bit of time to accumulate shares, which is I've talked about in the past and definitely still think about. Also, with the Fed raising these interest rates, you have to understand, obviously, it makes your houses more expensive. You're going to go buy a new house or a car or whatever. But it also allows people to actually earn some interest in their savings accounts. So we haven't talked about it a whole lot, but there's some online savings accounts that you should, go check out. American Express has one. Ally.com has one. Let me see what Ally's paying right now. So they have an online savings account. Let's see. Work faster internet. Let's see. What are they paying? Here we go. So they're paying 1.25% right now, ally.com. So if you look at Bank of America 0.01, Chase 0.01, Wells Fargo 0.01, Ally, you can do 1.25%, and all you do is link it to your checking account. This isn't a paid endorsement. There's some other ones. American Express has an online savings account as well. But this is a really good way to at least earn a little bit of interest on your savings accounts if you have them, and on maybe your emergency fund money that you're not trying to touch. But I do think that as interest rates normalize and we get to a place of a healthier market, and what I mean by that is you actually have an option. So when interest rates are zero, a lot of investors have nowhere to go except for the stock market. So they have to be in investments, right? Or they have to be in stocks. Well, when savings accounts are able to pay a little bit more, when CDs are able to pay a little bit more, you get a more natural market where there isn't so many people in the stock market speculating, increasing volatility, getting in the market, getting out of the market. And so if this goes according to plan, I think in a year or so, we might have a more normal market, which I think would be a very healthy thing for a lot of people. Unfortunately, the volatility that we've had over the last year, there will be people that'll lose a lot of money. Obviously, crypto, different things like that are just normal stocks. I mean, stocks that are down 80, 90%, they'll never come back to investing. And that's really quite sad because they just got, blown up, so to speak, and they never come back. And study after study shows, and the 2000 tech bubble, that happened. In the 2008 financial crisis, that happened. It'll happen again this time. And it's unfortunate because, especially if you're young and you learn some tough lessons, you should get back on the dance floor. but that's not always the case. So anyways, check out some of those online savings accounts, a way for you to be able to park some money in another place that isn't so touchable so that you kind of can keep your hands off of it. But it is a way to just make a little bit of extra money based on these higher interest rates. And based on the feedback, it seems like everybody enjoyed the Financial Scandals podcast. So I'm looking up some more. I should have known, the number one podcasts in the world are always true crime. If I could just, input some more killing or something into this podcast to get the numbers even higher, finance crime. I should have thought of this way before. So I'll look for some more scandals. They're great teaching tools and teaching us what to look out for and how to protect ourselves from things that seem too good to be true. So as we wrap up this week, earnings times are always a busy time in the market, especially for me reading all these earnings reports. So I'm going to keep it short today. But remember, go to Speakpipe, speakpipe.com/investor professor. Leave me a voicemail. Tell me what topics you want me to cover. You can tell me people you want me to interview or topics that you want me to find somebody to interview on. Whatever's on your mind, I'd be happy to hear from you. So I appreciate your time. Thanks for listening. Have a productive week. Never mistake activity for achievement. And I'll see you next time.